The last few days have been marked by two completely different narratives about oil. So, on one hand, we see experts saying that oil prices are going to drop even further. And on the other hand, there are others saying we're on the verge of a crude oil price explosion, right? So basically, the middle ground is gone. And my idea here is to give you an overview of what each of these perspectives brings and why each side believes in it. With that, you'll be able to make a more assertive decision and understand what this sector can bring to your portfolio right now. So let's get started. Let's start then with the bearish outlook. The main argument they have is that now the Gulf countries are flooding the world with oil. And honestly, they're actually right about that. For months, the Strait of Hormuz remained closed. Kuwait, Bahrain, and several of those countries couldn't ship out their production and ended up with a significant amount of stock just sitting there, mainly on tankers. But now that the strait has reopened, everyone has been flooded with all that oil that had been stuck and needed to get out of the Strait of Hormuz. And that put some downward pressure on oil prices. None of this is wrong. So the Gulf countries really are selling oil, and even at a discount. They're selling at discounts of $4 to $6 per barrel, even though the price is already relatively low. So, right now, we're not in a phase where there's a shortage of oil in the world. But there's a factor here that makes me think all of this is just a temporary movement. It's a window of time where this is happening. Because for 3 months, the world felt a shortage of oil. And to fight that, several countries, mainly the United States, used more than 1.2 billion barrels of oil from their reserves so that prices wouldn't rise too much. This stopped prices, in a way that contained that crazy spike everyone said was going to happen. But then, for maybe a bunch of reasons, which we might never really know, Trump made this deal, which nobody expected. And like I said, I still wonder if this is part of a plan. Honestly, if we look at the last few days, the intensity has come back, the attacks have resumed, both from Iran against the United States, the American bases, and from the United States in Iran. But I still believe they might reach some kind of agreement because the price of oil has already started to get stressed out based on these attacks that are happening. To me, it only makes sense if it's really part of a plan, because honestly, this was one of the worst deals I've ever seen in history. Well, but let's move on. So, if there's a lot of oil in the world, and there are also countries selling this oil below market price, right in the physical market, then the price tends to drop even more, doesn't it? And this is where things start to get a little more interesting, and we have to look at all the nuances, because the price of oil is already at a pre war level. We have thousands of additional problems that we didn't have before the war started. Not just with oil producers, but refineries in various places have been attacked during this period, and not just in the Middle East, but also in Russia and Ukraine. So many of these companies are no longer producing and refining at the same intensity. Many of them might take months or even years to rebuild their entire refining or oil exploration systems. Some wells were shut down and are now in the process of being repressurized again, especially over there in the Middle East. So there are several factors that suggest oil should be at relatively higher levels. But why isn't it? First, after the strait reopened, let's put it that way, countries no longer want to prioritize that route. Several cargo ships were stuck for 3 months inside the Persian Gulf. And for a company, if you look at it from the company's perspective, just think about the losses they had keeping a cargo ship idle for 3 months. Companies, they don't want to take that risk again of going in there and having their cargo ship get stuck again. Since the rest of the world still has a really strong demand for shipping, the priority is to pick up cargo outside the Persian Gulf. And for that reason, there's a compensation, right, from those Persian Gulf countries of $4 to $6 off, like I mentioned earlier. They have the product, but they're offering a discount because of the risk factor. Why? To find cargo ships willing to make those trips. Another reason is that nobody uses crude oil directly. Nobody fills up their car or truck with crude oil, right? Planes don't fly on crude either. The world uses gasoline, diesel, jet fuel, and those aren't the same thing as crude oil. It's the refined derivative products that are more important for our daily lives. And I'm going to explain here why I believe that this drop in oil prices won't lower American inflation. Why? Because while WTI or Brent, were plummeting, the prices of petroleum derivatives didn't fall at the same rate. So both gasoline and diesel dropped much less. Aviation fuel has also remained extremely expensive in recent days. Gas is also getting more and more expensive. So the problem is throughout the entire oil refining chain. And there's a data point that shows exactly this stress and this difference, right? It's called the crack spread. And basically, it's the most important answer for us to understand the current market situation and how stressed the energy sector is. So the crack spread is simply the difference between the price of crude oil and the price of the derivatives that come from it. So when this difference is very wide, it means that refining oil into gasoline and diesel becomes very profitable. When the difference is very narrow, it means that refineries have very small margins. And what's happening now is that this spread is unusually wide. American refineries, for example, are operating with extremely high margins, very close to the best margins in the industry's history. And all of this comes with an additional factor. Refineries are paying extremely low prices for oil. It's one thing for refineries to have a $50 refining margin when oil costs $150, for example. It's another thing to make a $60 margin when oil costs $68 or $69. And that's exactly the margin refineries are seeing. Today, we've hit more than $60 a spread, right? And how'd this end up happening, right? Why did this happen? Exactly because of what I mentioned. While crude oil prices dropped, the prices of refined products didn't fall at the same rate. So there's a structural pressure on fuel prices that the price of a barrel alone can't control. So even if the global oil market is flooded, that won't be enough to bring down the prices of refined products, especially because refineries are pretty much operating at their limit. The average American refinery capacity right now is around 98%. That means if a refinery can produce, say, a maximum of 100 units, they're already producing 98. So there's not much more room to increase supply and put more of these products on the market. More oil won't change the amount they can produce. So when we look at the stockpiles, the story becomes even clearer, right? Gasoline and diesel inventories in the United States are still below the historical average for this time of year. So there's less fuel available than there should be, and the market is pushing the prices of these refined products up. And basically, this is a very stressed industry, right? It's not a relaxed industry. It's not an industry that's operating with slack. It's an industry that's at its limit. They're squeezing out every drop of refined oil they can, right? And there's more, right? The Middle East, which is one of the regions that exports the most refined products to the whole world, is facing significant logistical problems that I've already mentioned before. So several ports in the Middle East are facing huge bottlenecks in this sector. So as I mentioned, right, the traffic through the strait is very dangerous and much lower than in recent days. So you have this current scenario where crude oil, in my view, is temporarily super cheap, but refined products are relatively expensive, both because production is at its limit and because of the difficulties in transporting and handling these products. Low inventories, especially in the United States, end up increasing the volatility of these products a lot, right? Because when you have a large inventory buffer, it gives you some extra security, right? Without this safety cushion, the risk becomes much greater, and as a result, volatility also increases and affects the markets. So looking at it from a perspective I've been talking about for several days now, it's amazing how things are unfolding. It's amazing how the price of oil keeps dropping, isn't it? Today, for example, there were 4 attacks by Iran in the Strait of Hormuz, and one of those attacks basically disabled a cargo ship, right? The United States retaliated, and now, 1 or 2 days after that, oil started to go back up, right? So I asked myself, does it make sense for oil to be at this price right now? To me, it doesn't make any sense at all. These days, the news goes like this: if the strait opens, great, oil prices drop. If the strait closes for some reason, oil prices drop too. So, in my view, we just can't get stressed out about this. Why? Because, well, every commodity involves more long term thinking, and the United States is patching up this problem with money using the reserves they have. So we don't know how long they're going to keep these oil prices artificially low. They don't want oil prices to go up, and basically, in a way, they're manipulating the market to keep it at these levels, mainly because of the midterm elections happening at the end of the year. Because with high inflation, that really hurts Trump when it comes to having a good election at the end of the year. So let's go. Based on that, we need to understand that the more resources the United States is spending in this process, the less they'll have for the coming months and to deal with this whole situation, right? Oil is already cheap, much cheaper than before the war started, and I believe it's going to get even cheaper. For me, that's kind of hard to wrap my head around. In 2002, we also had, during the invasion that happened in Ukraine, oil prices getting stressed and those spreads widening as well. But, one thing that's different is that back then, oil was at a much higher price than it is today. So what we're seeing now isn't even similar to 2008 or 2022. It's a scenario where the US strategic reserves have been depleted. They've been used exactly for what they're meant for, right? Commercial inventories have also been used up massively in the United States, and they're at their lowest levels in recent years. Refined product inventories are dropping significantly too. Industries can't produce anymore because they're already operating at full capacity. So we're seeing a huge mismatch in these two areas. And what is the most likely scenario to solve all these issues? For this spread to come down? Will oil prices go up and narrow this spread? Or will refined products tend to drop, right? Or is it possible that nothing will happen, and from now on, this widespread scenario will become the new normal? In my view, the longer it takes for things to get back to normal, the bigger this spread will get. This spread isn't going to stay the way it is. And like I said, we don't use crude oil. We actually use diesel, we use gasoline. If these products stay expensive, inflation isn't going to stop. What the United States avoids with cheap oil is a structural problem, especially when we're talking about treasuries, right? I have a video where I talked about this, about the impact of high oil prices on treasuries, especially with Asian countries. If you look at the price of oil that the market is pricing in, basically what I see is the market expecting a flood of oil to hit the market in the coming months, and probably with countries not replenishing their strategic reserves. But if you look at gasoline, diesel, inventories, refining capacity, refinery margins, and the Middle East, the answer gets a lot more complicated. The thesis is that oil needs to close this gap, the spread between crude oil and its derivatives, because the world ultimately has a limit to how disconnected the market price can be from what's actually happening in the derivative supply chain. And this disconnection isn't an anomaly, it's structural. So for me, the asymmetry in oil is huge. If it drops, how low could it go? 65. That's pretty much what it costs to extract shale oil. $62, $65 to extract it. American companies can even produce it, but they're not going to sell that oil at a big loss. Maybe it'll even help replenish part of the US reserves, which have dropped drastically in recent months. The problem is, as long as this spread between refined products and crude persists, the ones mainly affected are the end consumers. So airlines will charge more, trucking companies will pay more for diesel and pass that cost on to prices. The price for agriculture is also heavily impacted. It's not going to bring inflation down, right? Because we also use a lot of gasoline and fuel to get around. So countries that need to buy a lot of refined products are going to be heavily affected, right? And this, for sure, like I said, will also indirectly affect the United States, especially if these countries need to sell US bonds to raise cash. And here I want to invite you because inside the channel's members area, I really focus on this, on bringing up these aspects almost every day, right? I talk about some issues regarding how the commodities market is doing, which is the area I study the most, especially metals and energy commodities. For me, we're in one of the most important moments of the cycle. I still believe that we're in the middle of a commodities super cycle and that this drop is very similar to the one we had before the great financial crisis of 2008, right? Gold, for example, dropped 26, 28% before the financial crisis, just like we're seeing these days. And even though if we have a market crash, they could fall even further, I see these commodities at a structural limit, meaning that these companies, both mining and those related to oil, for example, are likely to make a lot of money in the coming months and years. So for me, investing in these companies is an extremely solid investment. I want to take advantage of this asymmetry that the market is pricing in right now, especially in the mining sector. So I invite you to become a member here on the channel to get access to this information firsthand. Everything I talk to you about here, I always do a study for the members first. So yeah, I end up going into much more detail, showing a lot more charts and details in that members area. So that's pretty much it, right? I'll also leave a link here and a QR code in case you want to talk directly with me to understand your portfolio and structure your entire portfolio, okay? A big hug to everyone and happy studying.